Good evening, students. Welcome to the session. I hope you have revised everything that we have discussed in the last class. Any questions that you have pertaining to last class? So, what we had discussed was we started with what is business, what is profession. We distinguished between different heads of income when it is PGBP versus, when it is IFHP, capital gain, IFOS. We discussed several things, right? And then we ventured into section 28, right? We just started profit and gains, right? So we discussed about the ICDS 1 accounting policies. We discussed about the ICDS 4 revenue recognition. So 28.1 is basically talking about profits, which we said that it is to be determined as per the commercial principles of the accounting, right? Now, what are commercial principles? Your normal principles, accounting standards. We also saw that 145.2 gives the power to central government to know CDS. Yes. So, any questions so far? Any doubts that you have at this moment before we proceed further? No? Okay. So let us proceed further then. So we have discussed about the ICDS 4 and ICDS 1, right? Now, what I wanted to discuss with is one another ICDS, which is ICDS 2, which is inventories, right? So why I'm discussing at this moment is because what we are talking about, profit and gains, right? So when you compute your profits, how do you compute your profit, students? You take into account your sales plus closing stock minus the purchases minus the opening stock. That will give you the profit. Yes or no? Of course, you gross profit and then you will deduct certain other indirect expenses and you get net profit. So here the valuation of the closing stock is very, very important, students. Isn't it? So that's the reason why we are talking about at this point the next ICDS, which is ICDS, ICDS 2. Correct? Now, let us look at what does our ICDS 2 talks about, right? So let me take you to ICDS. Let me just reshare the screen. Is my screen visible? Okay. So we are talking about the ICDS 2 now, which is the valuation of the inventories, right? What does it say? This ICDS is applicable for computation of income under the head PGBP or IFOS and not for maintenance of the books of accounts. And in case of conflict between the provisions of the Act and ICDS, the provisions of the Act will prevail. So this ICDS shall be applied for valuation of inventories except WIP arising under the construction contract, because for that we have a separate ICDS 3. Work in progress, which is dealt with by the some other ICDS. Shares, debentures and other financial instruments held as stock in trade, again, which are dealt with by the ICDS on securities, which is for there we have a separate ICDS. Producers' inventories of livestock, agriculture and forest products, mineral oils, ores and gases to the extent they are measured at the net realizable value. Again, we are not concerning for this also. Machinery spares which can be used in connection with tangible fixed asset and their use is expected to be irregular shall be dealt with in the ICDS on tangible or fixed asset. So whatever is covered in the separate ICDS, we are not concerning that. Now, what are inventories? Inventories are assets held for sale in the ordinary course of business, in the process of production for such sale, meaning we are concerning here the closing stock, we are concerning here the WIP, and in the form of materials or supplies. So closing stock of even the raw materials should be consumed in the production process or in the rendering of services. So all the inventories are covered over here. Now, inventories shall be valued at cost or NRV, whichever is lower. So how is the valuation of inventory? Cost or NRV, whichever is lower. Now, what is the cost of inventory? Cost of inventory shall comprise of all the cost of purchase. What is the cost of purchase? Cost of purchase shall consist of the purchase price, duties and taxes, freight inwards, any other expenditure directly attributable to the acquisition. Trade discount, rebates, other similar items shall be deducted in determining the cost of purchase. So for calculating the cost of the inventory, we shall take into account all the direct costs which are associated with the inventory. So which shall mean my actual cost of purchase, freight, duties and taxes minus trade discount. I will take into account all of that. Right? So let's just write it over here. This will include my cost of purchase, freight, direct cost, less trade discount, duties or taxes are also to be added, right? Then cost of services, in case it is for the raw materials, for the finished goods, it will include the cost of purchase. In case we are providing these services, then in that particular case, the cost of services shall consist of labor and other cost of personnel directly engaged in providing the service, including the supervisory personnel, right? Board is not visible. Okay, one second. Yeah, so you can take a note of it. I'll just wait for a second. Right? Okay. Let us proceed further. Then it includes the cost of conversion. So in case we are valuing the WIP, the cost of conversion of inventory shall include the cost directly related to the units of production, which is the variable cost, and a systematic allocation of fixed and variable production overheads that are incurred in converting materials into finished goods. Simple costing, right? So it will include for WIP, you will include the variable cost for per unit and you will also include the fixed cost. Fixed production overheads shall be those indirect cost of production that remain constant regardless of the volume of production. Variable are those which vary with the volume of production, right? For example, salaries are the fixed costs. Raw materials are basically the variable cost, right? And it will include any other cost incurred in bringing the inventories to their present location and condition. Are we clear? Now, how will you allocate the fixed production overhead? You will allocate in the cost of conversion based on the normal capacity of the production facility. Normal capacity is what basically the production expected to be achieved over a period of the production that I am undertaking, which will also take into account the loss of capacity resulting from planned maintenance, like normal losses which occur. The actual level of production shall be used when it approximates to the normal capacity. So the amount of fixed production overhead will be basically based on the normal production capacity which is there for that particular factory which is there. Are we clear? So any abnormal losses are to be ignored. Are we clear? So then they are saying that in case of period of abnormally high production, the amount of fixed production overheads allocated to each unit of production is decreased so that the inventories are not measured above the cost. So the value of the inventory cannot exceed the cost which you have actually paid. Are we clear? The variable production overheads will be assigned on the basis of actual use of the production facility because that is dependent on per unit. Are we clear? Now, if there are 2-3 products which are being produced simultaneously and the cost of conversion are not separately identifiable, then the cost will be allocated on some rational and consistent basis. Okay. And in case there is some scrap which is produced, any byproduct which is produced, then that shall be measured at the net realizable value and shall be deducted from the cost of the main product. Okay. Now, from the cost of inventories, what we will exclude is abnormal amounts of wasted materials, labors, or other production costs. Like as I said, that you will not include the abnormal losses. Storage cost, unless those costs are necessary in the production process prior to the further production stage. Administrative overheads that do not contribute to bringing the inventories to their present location, and selling costs. Obviously, these costs we don't include it in the inventory because these are indirect costs. Okay. So the cost of the inventory of items that are not ordinarily interchangeable and goods or services produced and segregated for specific projects shall be assigned by specific identification of their individual cost. Right? Specific identification means that, in case these products which are there, which are very specific, then the specific cost shall be attributed to the identified items of the inventory. Right? Now, what is the valuation methodology that you will take? So the cost of inventories shall be assigned using the FIFO method or the weighted average cost formula. Are we clear? So you can use either the FIFO method, first in, first out, or you can use the weighted average formula wherein the cost of each item is determined from the weighted average of the cost of similar items at the beginning of the period and what is getting added during the year. Are we clear? So just write down here. This cost shall be measured on FIFO or weighted average. Okay. And in case you want to measure the cost, either the standard cost or the retail method, whatever you want. So standard costing, we have done it in the part of the costing chapters, right? Or costing subject, which basically takes into account the level of the consumption of the material, labor, efficiency, capacity utilization, right? Retail method is basically used where you are into the retail trade for inventories and where there are margins associated. So then in that particular case, the cost of the inventory is determined by reducing from the sales value of the inventory the appropriate percentage of gross margin. Are we clear? So you will compare this cost with the net realizable value. Net realizable value is basically the market value which is there, and based on that you will arrive at the value of the inventory. So cost or NRV, whichever is lower. And in case of the dissolution partnership firm, BOI, then notwithstanding whether the business is continued, discontinued, the inventory on the date of dissolution shall be valued at the net realizable value. So you can write it over here. In case of dissolution of the partnership, inventory to be valued at net realizable value. Are we clear, students, for ICDS 2? Any questions, any doubt? Yes or no? Clear? Okay, perfect. Now this is, see, as I said, is excluding the valuation of the shares, debentures and other financial instruments held as stock in trade. Because for that, we have a separate ICDS on securities. So let us look at that also because that is very similar, which is ICDS 8. What does ICDS 8 says? ICDS 8 is applicable for income chargeable under the PGBP or IFOS, and this is not for the purpose of maintenance of books of accounts. So see, they are again and again emphasizing that these ICDS are only to compute your income. You will not maintain your books of accounts as per the ICDS. Are we clear? So this ICDS deals with the securities held as stock in trade, right? So this is for inventory, but in case of my securities held as stock in trade, I have ICDS 8. Okay. So this part of ICDS does not deal with the basis for recognition of interest and dividends on security. So this will not cover interest and dividend because that is taken care by which ICDS students? Interest and dividends on securities is taken care by which ICDS?
4. Revenue recognition.
Yes, very good. So therefore ICDS 8 will not come into picture. This is only for valuation of securities held as stock in trade. Securities held by a person engaged in the business of insurance. Again, this ICDS will not talk about that. Securities held by mutual funds, venture capital funds, banks, ICDS 8 will not talk about that. Why is that so? Yes, because the banks, insurance, mutual funds, these are governed by the separate legislation under which they have different methodologies for valuation. So therefore, ICDS 8 is not conflicting with them. Are we clear? Now, coming to the ICDS 8. What are securities? Securities are as defined under the SCRA, Security Contract Regulation Act. And this shall also include share of a company in which public are not substantially interested. What is the meaning of company in which public is not substantially interested?
Closely held companies.
Yes, but what is the meaning of closely held company? Which companies are closely held? Unlisted Geet, yes. Which companies are closely held? Yes, Chitra, private company. So unlisted company, which is not a subsidiary of a listed company. Unlisted company, but it should also not be a subsidiary of a listed company and a private company. Those are the closely held company. Are we clear? Now, here it say, but it will not include the derivatives. Okay, so securities will not include the derivative. Now, what they are saying here is that a security which is there on acquisition shall be recognized at the actual cost. Right? So, when you purchase the security, you will recognize at actual cost. What is the actual cost? The purchase price and include the acquisition charges such as brokerage, fees, tax, duty, cess, whatever is there. Are we clear? So, just write it over here. Recognize on the purchase at actual cost. What is my actual cost? The cost of purchase, which is the purchase price, plus brokerage, cess, and tax and duty. Now, students, do you see a distinction over here and what we see under the capital gain? Yes.
In capital gain, STT will not be allowed.
Yes, very good. So, under the capital gain, when you take the cost of the security, there is a specific prohibition under section 48 which says that STT will not be allowed as a deduction. Whereas in case of the security held as stock in trade, here what they are saying is that this purchase price shall include my tax. So meaning STT is allowed here. This is not allowed if held as capital asset. Are we clear, students? So this is how you have to appreciate the differences, and this is how you will be also able to write in the exam, students. Clear? Now, where a security is acquired in exchange for any other security, like a exchange kind of situation, one security you give, you get another, which happens in the case of, can you give an example of when does it happen? Securities acquired in exchange for other securities.
For ESOPs, for service, securities are excluded.
No, in ESOPs, you just get the direct, shares allotment. You don't get it in exchange of something else. Yes, Pitambar, that's very good. Amalgamation.
Merge.
Yes, mergers. In the mergers, you get the security of the amalgamating company in exchange of the shares of the amalgamating company. Yes, yes, very good, Chitra. Conversion of debentures into shares. Yes, that's also correct. So in those cases, yes, redeemable preference shares. Yes, Geet, those are also the correct answer. So yes, in those cases, the fair value of the security acquired shall be the cost of the new security. Are we clear? So whatever you have acquired, the fair value of that security will be the cost. It will not be the cost of the original asset that you held. It is the fair value of the security will be considered as the cost. Where the security is acquired in exchange of any another asset, then the fair value of the security so acquired shall be the actual cost. When you give your own asset, like let's say for example, when you are selling the asset and then you are getting the equity in some other company. Very fair deal, right? In case of slum sale, in case of demergers, in case of any transfer of any plant and machinery, which is kind of a very big plant and machinery. In those cases, what they do is they give you the shares of their own company. So in those cases, what we will do is we'll consider the fair value of the security, right? So just write it over here. In case of security acquired in exchange of another security or asset, then cost will be fair value of security acquired. Are we clear? Now, where unpaid interest has accrued before the acquisition of an interest bearing security, right? And is included in the price paid for the security. The subsequent receipt of interest is allocated between the pre-acquisition and the post-acquisition period. The pre-acquisition portion of the interest is deducted from the actual cost. Now, this is what we have learned even under the investment accounting. Can anybody explain me this meaning?
So if a security is acquired and interest is not paid till then, so if I am acquiring the security, then I will be paying the interest amount also to the person from which I am acquiring the security. And later on, when the company pays the interest, he will be paying to me. So I will be reducing the interest amount from the cost of the security.
Yes. So if you remember AS13, what is AS13? Yes. What is AS13, students? Yes, IPCC. What is AS13? So AS13 is the right. So whenever the interest are there on security, these are considered generally as your income, right? Which is the return on your investment. However, in some cases, for example, when the interest has accrued before the acquisition of the security, interest bearing security, right? We are not talking about the dividend bearing, the interest bearing GSEC securities, debentures, which are there, right? So, when the interest has accrued before the acquisition of that investment and is included in the price which is paid, like let's say, for example, you have acquired the security on 10th of August. Now, interest on that security is due every first of the month, right? So the seller will tell you that look, you don't have to pay rupees 100 as the purchase price of the security. You need to pay me 100 plus 10 rupees interest for the period of 1st August to 10th August, because till that time I had held the security. So interest should also be given to me for 1st to 10th. Right? Now, when on the 1st September, you get, let's say, interest of 30 rupees. Now, will you consider the entire 30 rupees as your interest? Answer is no. That is not your income. Your income was only 20. 10 was paid to already the seller. So, on the receipt of the interest, you will allocate it 10 as the pre-acquisition and 20 as the post-acquisition interest. The pre-acquisition interest which is there, the 10, you will reduce from the cost of the security. Are we clear about this? We will reduce from the cost of the security. Yes, Keith, that is right. Yes. So you have to adjust in this particular way. Fine. Is this clear, everybody? So that's what your ICDS 8 also talks about. Now, subsequent measurement of security. This was at the purchase. Now, at the end of the previous year, the security held as stock in trade shall be valued at actual cost or NRV, whichever is lower. Right? So, closing stock will be valued at same as your ICDS 2. Actual cost or the NRV, whichever is lower. Right? Now, for the purpose of this valuation, the comparison of the actual cost and the NRV shall be done category wise and not for individual security. Now, this is very, very important, students. What they are trying to say is that the securities shall be classified into this type: shares, debt security, convertible security, any other security. So, let's say, for example, so valuation shall be done security wise and not, sorry, valuation shall be done category wise and not individual security wise. So what are my categories? let's say shares, debt, security, convertible, security, and any other. So let me give you an example for this. Let's say, for example, if I have, let's say, equity shares, right? Now, let's say I have company A, B, C, right? Let's say my actual cost is, this is my NRV, and this is my valuation, right? So, let's say actual cost here is 100, this is 110, this is 90, this is, let's say, 50, this is, let's say, 150, and this is, let's say, 100, right? So now this is one category I have. Secondly, I have, let's say, convertible debentures, right? So let's say again I have A and B. Let's say again 1000, 1100, 900, 1000, right? So how will I value? I will not value like this 100, 110, so 100, 90, 50, let's say 50. No, this is not how it has to be done. It has to be done the total of this versus the total of this. So this versus this has to be the comparison. Similarly, the total of this, which is 1900 versus 2100. So the value shall be 1900. Are we clear? Yes or no, students? Yes? Okay, perfect. So the value of security of as on the beginning of the previous year shall also be done in the similar manner. Are we clear? Now, notwithstanding anything contained in para 9, 10, and 11, where the actual cost, at the end of the previous year, security not listed on a recognized stock exchange or listed but not quoted on a recognized stock exchange with regularity from time to time shall be valued at actual cost initially recognized, because obviously in that case you will not be able to find the net realizable value, right? So this is only for the listed security. For unlisted security or unquoted. Unlisted is different from unquoted. What is unquoted? Not quoted on recognized stock exchange regularly. Like they get listed, delisted like that. So in those cases, value shall be the actual cost. Are we clear? Yes?
मैम कोटेड सिक्योरिटी का मीनिंग क्या है?
I said, like it is not quoted on recognized stock exchange regularly. Not quoted on recognized stock exchange means like it gets listed, delisted, like that. It is not quoted regularly. Like it is a listed share, but it gets delisted sometimes. Again, it gets listed back. So those are the unquoted shares.
ओके.
Okay. Yes. So this completes your ICDS A. Are we clear? Yes. Any questions? Any doubt? Yes or no? So we have completed first part of section 28. What were we looking at? Can somebody summarize this for me? What were we looking at? How did we come to ICDS 284? Where did we start from? Can somebody summarize?
We started from section 28.1 profit and gain from the business. Uh, Profit and gain from the business are a profession carried on by the SSC at any time during the previous year should be charged under the head PGBP. So we are looking at profit and gain. What is the meaning of profit and gains. So profit and gain should be calculated as per the commercial accounting principles, fundamental accounting standards, and those things. And also section 145, the method of accounting says that account it should be calculated based on cash and mercantile system basis. And also 145.2 gives power to the central government to notify the ICDS, and whoever is following the mercantile system, they have to follow ICDS also. For this, there are assumptions, exceptions, individual and HUF who are not following the tax audit, and also who is following the cash basis system, they don't have to follow the ICDS. Right?
Very good.
From there, we have seen that again, capital receipts and mm, revenue receipts. Revenue receipts should be considered always, and capital receipts should be considered only when it is specifically specified. Otherwise, we should not consider them. Then from there we came to ICDS. ICDS 1, fundamental accounting principles, going concern, consistency in accounting policies, and accurate basis of accounting system. Then we saw ICDS 4, revenue recognition. In ICDS 4, revenue recognition, sale of goods, sale of the revenue should be recognized when the seller has sold the goods to the buyer, or risk and rewards have been transferred to the buyer. That means that the seller don't have any control on the goods. Then for the sale of services, it is based on the percentage of completion method. And exception is that if the service is for less than 90 days, then it can recognize it on the completion method. And for the interest, we will be recognized on the time basis. And for a next will be interest on IT refund. It will in the previous year in which it is has been received. For the IT and discount and premium on the securities, it have to be amortized over the period of the security period of time. And for revenue recognition, we should recognize when it is realizable. If it is not realizable, then we should not recognize the revenue. And moreover, we have looked into the 145B for escalation price and for export incentives. They have to be recognized as the revenue at the time when it is reasonable that the revenue will be recoverable. And also more for the government grants, subsidies, and those things, when in the previous year in which the revenue has been received, we have to recognize the revenue, except for the capital cost of the asset which is to be capitalized. Those have to be capitalized and should not be recognized as the revenue. And for royalties, we have to recognize as per the agreements. For the dividends, we have to recognize as per the section 8. Section 8 says that whenever it is declared, paid, or distributed, and for the interim dividend, whenever it is unconditionally made available to the shareholders. That is ICDS 4. Then we came to ICDS 2, inventory valuation today. Inventory valuation, it is for PGBP and income from other sources, and not meant for maintaining of the books of accounts. And it valuation is lower of the cost or NRV, and the cost is the cost of the purchase, freight cost, duties and taxes, and trade discount should be reduced, and other this whatever inputs we get, that will be reduced. And cost of the service and the cost of the services and cost of conversion cost will be variable cost per unit and fixed cost per unit. Then if any scrap or byproduct is there, will be there, then we'll be value them at NRV and we'll be reduced it from the cost of the main product. And also we will be allocating the fixed cost and those at the normal capacity. And if there is any normal loss, it will be considered, but abnormal losses and abnormal losses will not be considered. And we will be follow FIFO method, a weighted average method. LIFO method is not allowed here, and standard costing or retail method is allowed. In case of dissolution of partnership firm or AOP, we will be following the NRV value. We have to measure it at NRV only. Then we came into ICDS 8, securities. For the securities, again, it is for income for PGBP or income from other sources and not for the maintaining of books of accounts. Here, security is held as the stock in trade, not including the derivatives. Interest and dividends is also on the securities are not considered here because it is ICDS 4, and mutual funds, insurance, banks, and venture capitalists are also not covered under ICDS 8 because they have separate constitution so as to not to conflict with them. And recognition on the actual cost of the purchase price plus brokerage plus taxes and duties. Here, the difference between capital gains and PGBP FIT is that taxes is not allowed in capital gains. The STT transaction is not allowed. Here in PGBP, it is allowed as expense. Then security to security. In case of security acquired in exchange of another security or asset, then cost is the fair value of the security acquired. Interest accrued on the security, it is added in the cost. Then when it is post dividend, post interest when it is received, we have to reduce the pre interest from the cost of the asset, and only the post interest should be the income of our income. And again, at the closing stock, it is valued at lower or the actual cost of NRV. Valuation shall be done category wise and not an individual wise. Categories are shares, debentures, convertible securities, or any other securities.
Very good. Very good. Very nicely summarized. And I am very sure that you have studied it properly as well. So keep up. It's very well summarized. Thank you so much. Okay. So next, are we moving towards section 28? Section 28, we discussed profit and gains. We have one part. Completed from business or profession. We have completed that. Next is by the assessee. Now, what does this mean? Carried on by the assessee. Let us understand this. So, whether the business should be carried on, like by the assessee himself, right? Or it can include the business carried on by the agent of the assessee. Now, if you remember, we had done something under the contract law, right? That any act done by the agent is as good as that the act is done by the principal himself. Do you remember this principle? Yes,
Yes, ma'am.
was a common principle that we had which said that any act done by the agent is as good as that it is done by the principal, right? So even any act done by the agent, like agent is who? Agent is working for me only. Yes or no? So he is just working for me. He is working to do my sales. Right? So there is no difference between me and the agent. So here when I talk about that the business carried on by the assessee, it does not mean I will exclude the profits which are carried on through the agent. Are we clear? So here you should, like just for the sake of I'm explaining just to know this, it's not really important for the examination. There is something called as a legal maxim. Sorry. I don't know why it's not reading. This is a legal maxim. Okay, what does it say? This principle says that any act done by the agent, ki facet per alam facet se. So this means that he who acts through another acts himself. This is the principle in the law of agency. So it means that when somebody authorizes another person to act on their behalf, they are responsible for the action of the other person. The agent is not an independent agent. Right? Let's say, for example, if tomorrow Samsung says that I have sold the TVs through Vijay Sales. Now, Vijay Sale is an independent agent. Obviously, he is doing it on a retail basis. But if somebody is an agent, then the actions of the agent will bind the principal. The principal will be like customer. Yes or no? So the carried on by the agent here means that the carried on by the assessee. So this will include business carried on through the agent. Or let's say dependent agent. Are we clear? Now next is profit and gains from the business or profession carried on by the assessee during the previous year. Now, what does this particular clause means? See student, this is very, very important. What this means is that, let's say for example, if I have certain income which is arising only during that previous year, I will take into account only that income, meaning any advances that are received, right? Any kind of uh, advances that are received, that I will not consider for the purpose of computing my profits, because the wordings here are carried on by the assessee during the previous year. Are we getting this particular point? So when I say during the previous year, I have to only account for the income for the business carried on during that particular year. If the business is carried on in the another year, I will not account for that particular profits. Rather, I will not take into account any receipts. I will not take into account any expenses also. So that's the reason why you see that we take the expenses on the accrual basis, right? We also take the income as we provide the services or provide the goods. Are we getting this particular point? So carried on during the previous year is very, very important. Right? So first thing is profit and gains from the business or profession carried on by the assessee during the previous year. Now tell me one thing. What about the provisions that we make? So whether those provisions are to be allowed, these are just provisions. I'm not saying that the expenses have been incurred. These are the provisions. Will you allow the provisions under the Income Tax Act?
No, ma'am.
Why no?
Because they have not yet occurred during the previous year.
Correct. So any kind of provisions which are there, these are not yet incurred. Right? These are not yet incurred. So any future amount, right? Any expenditure which is to be paid out only in future is only a provision which is based on the present value of the future liability that is going to arise. Count for that. And yes, you have rightly pointed out, Geet, that as per ICDS 10. So we are going to now go towards the ICDS 10 also. So any liabilities, expenditures which are basically there for this particular year, that we will consider. However, any future expenses for which I am just making the provision at this point in time, I will not allow that. Are we getting it? Because these are not yet incurred. These are not yet incurred. Clear? Then, therefore, we should say that any kind of provisions will not be allowed. What about the provision for warranty? Whether we will allow that?
Yes, ma'am. Why? Because it will the amount will be automatically added in the sale value.
No, it will not be added in the sale value.
मतलब जब बेचते हैं तब भी है ना, नहीं वो सेलर है जी को वो वारंटी का पैसा तो ले ही लेता है ना कस्टमर
See,
से.
they will take in the sale consideration, but whenever you provide the warranty, obviously there are costs associated. If that be the case, I take value or costs which are there, right? I take the purchase cost also, recovery of everything, I take it. But at the end, I add the profit. So how is the profit arrived at? The profit is arrived by sales minus all the expenses, isn't it? So warranty expenses also I will claim, but I'm asking the question in respect of provision for warranty, whether that will be allowed, because we are saying that we will not allow any kind of provision because that is not based on the current year expense. So whether provision for warranty will be allowed in that particular case. Yes. See, so what I'm here trying, if it is certain, yes, Geet, very good. So here, income and expenditure of the previous year are to be considered. That is very true. But here, I will not get deduction for the provision. However, what kind of provision will not be allowed is that provision when a reliable estimate cannot be made. Only those provisions will be disregarded. So for gratuity are not allowed as deduction. Provision for doubtful debts are not allowed as deduction. Actual bad debts are allowed. Actual contribution of gratuity is allowed. Are we getting it? So during the previous year means that I will allow only the income and expenditure of the previous year. But I will allow certain provisions only as per ICDS 10. Okay, so now we are getting into the ICDS 10. So let's just write it over here. Okay, I think we have missed here one point, at any time. It says at any time during the previous year. So we'll get back on the word at any time also. Everything has a meaning. So we'll look at this particular thing, but now we are on the during the previous year. So what does this mean? Income and expenditure of the previous year are only allowed. So that means advances not recognized. Yes, advances are not recognized. Of course, this is when you follow the accrual system of accounting. If you follow the cash system, then of course the it's a different story, right? So this is about the accrual concept, right? So income and expenditure of the previous year are only allowed. This is when you follow the accrual system. In the case of cash system, this is not applicable. Cash mein to you will account whatever is received and whatever is paid, right? So what is not allowed is the prior period expense are also not allowed, and the provision for future expenses unless as per ICDS 10. Obviously, you will not allow any prior period expenses also. Can we get prior period expense deduction? Answer is no. Provision for future expenses also we will not get. But there is something called as, principle of conservatism. What is that in the accounting? What is the principle of conservatism? Yes.
Recognize all probable liabilities and expenses.
Correct. So we will not recognize any probable incomes, but we will recognize any probable expenses. That's where this concept of provision comes. So what does this ICDS 10 says? ICDS 10 is applicable for computation of income under the PGBP or IFOS, and again not for maintenance of books of account. In case of any conflict between the provisions of Income Tax Act and the ICDS, the provisions of the Act will prevail. Now, what does ICDS say? ICDS say that it will deal with provision, contingent liability and contingent assets except those resulting from financial instruments, from executory contracts, insurance business, from contracts with policyholders covered by any other ICDS. So this does not deal with the recognition of revenue which is dealt with by the ICDS revenue recognition. Now the provision is also used in the context of items such as depreciation, impairment of assets, doubtful debts, which are adjustments to the carrying amount of assets. What is a provision? Provision is a liability which can be measured only by using a substantial degree of estimation. Right? Now, if you look at what it says, recognition, a provision shall be recognized when a person has a present obligation as a result of a past event. So any past event has occurred and I have some kind of obligation which is there. So let's write it simultaneously. What does ICDS 10 says? Provision shall be recognized when there is present obligation arising out of past event. Right? A person has a present obligation as a result of a past event. It is reasonably certain that an outflow of resources embodying the economic benefits will be required to settle the obligation. So there is some sort of reasonable certainty that yes, 80%, 90% chance is there that yes, there will be flow of resource, will be a hit to my balance sheet and P&L, which will be required to settle that liability. So first of all, I have an obligation as a result of some past event. Some event has occurred because of which I have some kind of obligation. And there is a reasonable certainty that yes, I will have to pay off that liability. Right? And a reasonable estimate can be made of the amount of that liability which will be arising. So there is a present obligation arising out of past event. There is reasonable certainty, there is reasonable certainty that there will be outflow of resources to settle the obligation and a reliable estimate can be made for amount of obligation. So what are the three conditions? One, there is a present obligation. There is a liability which is occurring out of the past event. And there is a reasonable certainty that I will have to pay that obligation. Right? And I can estimate the amount reliably for, I can't accurately make, the words used are reliable. In those cases, I will be recognizing the provision. Classic example of this is provision for warranty. Now you will ask, ma'am, how we can estimate the provision for the warranty? See students, we can make the estimate for the warranty because the warranty provisions which are there are based on the actuarial valuations. What is actuarial valuation? Basically, an actuary values based on the past claims that have been made by the customers. Let's say when I sell the TV, if I see there is a probability that out of 10 TVs that I sell, 5 customers come every year for the repair. Right? So there is a present obligation arising out of a past event. Now, there is a reasonable certainty that there will be some outflow of the resources. Yes or no? And I can make a reliable estimate based on the amount of the warranty which is going to arise. Based on my past claims, I can make a reliable estimate. That may not be actual. Let's say in this year, 7 customers may come. In 1 year, 4 customers may come. But there is a possibility that between this, it will come. So I will then recognize the provision for the warranty if it is based on some scientific evidence. Now, in that case, if you will ask like why provision for doubtful debts we can't make? Because that is not on some scientific evidence. Isn't it? That is not on the basis of some scientific evidence. Because the provision for doubtful debt which is there, that is that, we are just thinking that, okay, this debt may not be recognized. So in that particular case, we will not recognize that particular provision. We will not recognize provision for gratuity. Again, not based on any scientific evidence. How much gratuity I will have to pay? I don't know. How many employees are retiring? How will I know? So, and plus there is a specific disallowance for that. Whatever you may say, okay, we may argue that no, provision for gratuity is also based on some scientific basis. Whatever you may say, section 40A9 specifically disallows the provision for gratuity. Section 36 specifically disallows the provision for doubtful debts. So these kind of provisions are any which ways not allowed under the income tax law. So you may say, you may argue otherwise that no ma'am, even these should be allowed, but these are specifically disallowed. Are we clear? So let's just write it over here. Provision for gratuity specifically disallowed under section 40A9. Provision for doubtful debts, again disallowed under section 36(1)(5). Are we clear? Now what does my ICDS says? If these conditions are not met, no provision shall be recognized. So only when I have this certainty, right? In that particular case, I can recognize the provision. So I will recognize the provision only for the ascertained liabilities. Remember this word. Recognize for ascertained liabilities. So meaning I will not recognize for unascertained liabilities. Liabilities which cannot be ascertained. I will only recognize for the ascertained liabilities. Liabilities in presenti. Latin phrase is liabilities in presenti. Liabilities in futuro are not to be recognized. Liabilities of future are not to be recognized. This is called as, in Latin, liabilities in presenti. And unascertained is liabilities in futuro. Are we clear, students? Yes. So during the previous year means income and expenses of the previous year are only allowed. Of course, there are certain kind of exception to this. So when we say we will not allow prior period expense, provision for future expenses, there are of course, some exception over here. What are the exception under the income tax? (43)(b). Deduction to be allowed only on payment basis. Right? So even when the expenditure is incurred during this year, if I pay it in the next year, I will get the deduction in the next year. Section 40A1. If I fail to deduct the TDS during this year on the expenditure, I'll be allowed in the year in which the TDS is deducted and paid. So these are certain expenditures which are allowed, but on the exceptional basis, these are allowed in the year in which TDS is deducted and paid, or in the year in which payment is made. Are we clear? So prior period expenses and provision for future expenses is not allowed. What does this ICDS further say? No provision shall be recognized for cost that needs to be incurred to operate in the future. As I said, liabilities in futuro are not to be recognized. It is only those obligations arising from the past events existing independently of a person's future action, that is future conduct of his business, that are recognized as provision. Where the details of the proposed new law are yet to be finalized, an obligation arises only when the legislation is enacted. So this is very important. So let's say, for example, if tomorrow new income tax bill is going to get passed, it is not yet passed, it's just at the bill stage, right? Now tomorrow, if there is some kind of liability which is going to arise in terms of new tax liability is going to arise, new penalty is going to result over there, will I recognize? The answer is no, because the law is yet to be finalized. The obligation will arise only when the law is actually passed. Now, once it is passed, you are sure, okay, there is going to be penalty. Then I will recognize. Are we clear? Contingent liability, a person shall not recognize the contingent liability. What is contingent liability? Contingent liability is different from provision. Contingent liability is a possible obligation. Is a possible obligation. Can you give me an example of contingent liability?
Court case.
Court case, yes. So I will provide it as a footnote. right? But I will not recognize that. I will not recognize that because this is a possible obligation. I may win, I may lose. The existence of this liability will be confirmed only when I win the case, which is an uncertain future event, which is not in my control. So what is contingent liability defined over here is contingent liability is a possible obligation that arises from the past event and the existence of which will be confirmed only by occurrence or non-occurrence of the future uncertain event, which is not in my control. Or it can be a present obligation also that is arising from the past event but is not recognized because it is not reasonably certain that there will be outflow of resources or a reliable estimate cannot be made. Provision for doubtful debts. Are we clear? Contingent assets, again, I will not recognize. Contingent assets are possible asset. I may win the case. I may get the refund of my tax back. Again, this is contingent. Based on uncertainty, I will not recognize. So only when it becomes reasonably certain that yes, I will get some economic benefit, then the asset and the income will get recognized. Are we clear? Any doubts over here, students? Yes? Okay? Yes or no? Any questions? Any doubt? Fine? Okay. Now the last point before we go on the break is at any time. So profit and gains from the business or profession carried on by the assessee at any time during the previous year. We have left the word at any time. What do we mean by any time? So see students, in case of the accrual principle, right? If my business gets discontinued, if I discontinue the business, then how do I recognize the income? Because business is discontinued. See, when it is a cash basis of account, then when it is a cash basis of accounting, then yes, whatever I have recognized is my receipts and my expenditure which is paid. But when it comes to the accrual principle, how do I recognize the income when the business is discontinued altogether? So for that purpose, we have something called as, let us look at it, Section 176. Section 176. What does it say? Let us look at it. Discontinued business. 176 talks about the discontinued business. Now, 176.3a, if you look at the 176.3a says where any business is discontinued in any year, any sum received after the discontinuance shall be deemed to be the income of the recipient and charged to tax accordingly in the year of receipt. Are we clear? So basically, we will follow in that case the cash basis. 176.4 is for profession. 176.3 is for the business. 176 is for the profession. It says where any profession is discontinued in any year on account of cessation of the profession or by the retirement or death of the person carrying on the profession. Then any sum received after the discontinuance shall be deemed to be the income of the recipient and charged to tax accordingly in the year of receipt. Are we clear? So let's just write down. 176.3 is for business. 176.4 is for the, 176.3a, not 3. Is for the profession. Receipts after discontinuance, charge to tax in the previous year of receipt. Are we clear? So at any time means even if the business is discontinued, after that also if the income is received, charge in that for business and for profession both. So before we go on, we started with section 28, which is 28(1), which is the general charging section. Profit and gains to be computed as per the commercial principles of the accounting, which is basically my accounting standards. I will recognize all revenue receipts. I will not recognize capital receipts unless specifically charged to tax. For example, the compensation for the liquid damages on plant, that is now specifically chargeable to tax. I will recognize all revenue expense. I will not recognize capital expense unless specifically allowed. For example, 35 allows for capital expense. 145(2) says you take into account CG will notify the ICDS. So 145(2) says that those are to be taken into account. 145(1) says that you can follow cash or accrual basis of accounting, whatever you follow. ICDS is applicable only for accrual basis, right? ICDS is not applicable on cash basis, not applicable for individual and HUF who are not getting the tax audit done. We saw one says 3 assumptions: going concern, consistency, and third was what? Yes, revise with me.
Accrual basis.
Sorry?
Accrual basis.
Accrual basis. Yes, that's correct. So going concern, consistency, and accrual. Yes, Geet, correct. So yes, Sandeep. These are the 3 assumptions. ICDS 4, we saw the revenue recognition. Yes, revenue recognition for sale of goods only when there is reasonable certainty of the ultimate collection. And sale of goods basically when the goods are transferred so that the risk and rewards are not with the seller. Right? So only then you will recognize, but you will not postpone beyond the reasonable collection, reasonable certainty of the collection of amount. In case of escalation prices, export subsidies in the year of receipt. Then 145B also we looked into it. That talks about the export subsidies and the escalation claims. That is to be recognized in the previous year of receipt. Right? That is to be recognized in the previous year of the receipt. Yes or no? So, sale of services, percentage of completion basis, except the contracts are for less than 90 days. In that case, project completion basis. Interest on time basis, discount on zero coupon bonds, premium on security, amortize over life of security. Interest on income tax refund in the year in which it is received. Royalties, accordance with agreement, dividend as per section 8, which is saying distributed, declared or paid. Interim when it is unconditionally made available. Subsidy, grant by the central government, state government, duty drawback, waiver of the loans are recognized in the year in which it is received, except when it is capitalized as per 145. Then we saw ICDS 2, cost or NRV, whichever is lower. Exception is in the case of dissolution of partnership, inventory is to be valued only at the NRV. So this is my exception. Right? So you have to remember this. This is my exception. Are we clear? ICDS 8 also for the security category wise, you will do the cost or NRV, whichever is lower. Then business or profession. We saw what is business? The trade, commerce, manufacturing, adventure in the nature of trade, commerce, manufacturing. So isolated transactions are not to be taken unless the intention is to do the business. Right? My intention should be to undertake the business activity. You have to look at the regularity, whether it's an organized and systematic activity which is carried out. If it is organized and systematic activity, one of a kind will also involve the business. Profession includes the vocation, some degree of skill, right? Business or profession. Carried on by the assessee will include the act of the agent, carried on through the agent. At any time will include the receipts after the discontinuance as per 176. During the previous year, you will recognize income and expense of previous year. You will not recognize prior period expense, future expense, advances, except which is as per ICDS 10. Of course, there are exception 43B, 40, which are there. ICDS says that provision is to be recognized only when there is a present obligation out of past events, reasonable certainty is there that there will be outflow of resources, and a reliable estimate can be made. Provision for warranty, therefore you can claim. Provision for doubtful debts, gratuity not allowed. Are we clear? Are we good to go to break? Yes or no, students? Okay, so let us take a break 1 second. Before that, there's a question. What if about any payment arises with respect to discontinued business? If any payment arises, yes, you will allow that as a deduction also. That is not a problem. Yes, Pitambar. Okay, so let's take a break of 15 minutes and then we get back. Students, so let's start back. Now we are moving towards the next provision, which is 28.2. Okay. Now these are the specific charges. Let us discuss that. Let's go back to 28. We have just seen the general charge of 28. We are still under 28, students. Okay. We have not come out of 28. So you can imagine, see how important, conceptual the entire PGBP chapter is, isn't it? Okay. 22 says any compensation or other payment due to or received by any person who is managing the whole or substantially the whole of the affairs of an Indian company at or in connection with the termination of his management or the modification of the terms and conditions relating thereto. So any compensation which is given to a person who is managing the affairs of the Indian company, right? Maybe CEO, maybe CFO, right? In connection with the termination of his management or the modification of the contract's terms and conditions. Now see, when you give any compensation to any person, why you are giving this compensation for? Because this particular person, right, was working for this management of this entity. Right? This particular company was working for management of this particular company. Now, if let's say, for example, tomorrow they terminate the particular contract, or let's say, for example, they say that no, we don't want to continue your salary, what we are paying at this moment. So in that particular case, there is alteration in the terms and conditions of the contract. Now for that, the company is compensating him because right now you had a contract with us. Now we are just, terminating it or modifying the terms and conditions of that contract, and because of which we are giving you the compensation. So this is a compensation which is given to sterilize the or compensation for the sterilization of the profit making apparatus. Compensation for the sterilization of the profit making apparatus. Because your profit making apparatus is basically whatever the machinery that you are using to generate the profit. Now, there is no machinery, the machinery, right? So, whatever you were doing till now, we have sterilized it, we have halted, we have altered it. Now, any alteration that has happened to your profit making capacity, for that we are giving you the compensation. What should be the nature of the compensation, students? What is the nature of this compensation? Yes.
Cash or in kind?
Sorry?
Cash.
No. Whether it's a revenue receipt or whether it is a capital receipt. That's my question. Yes, Pitambar, it is a capital receipt. Right. So any compensation with respect to connection with the termination or modification of the terms and condition of the different categories which are mentioned over here. Right. So in this case, what are the categories which are mentioned? To the person who is managing the affairs of the company, affairs of the Indian company, who is managing the affairs in India of any other company, meaning any foreign company, in connection again with his termination or modification of terms, of any agency agreement of any person holding an agency in India for any part of the activities relating to the business of other person. So any agency agreement that I terminate or modify the terms and condition for that. Any in connection with the vesting in with the government or any corporation owned or controlled by government, so government or government company, under the law and force for the management of any property or business. If you're managing the property or business for government or government company, in connection with the termination or modification of the terms and condition of any contract relating to his business. In all these cases, if the compensation is paid, this is towards the sterilization of the profit making apparatus. Let's say, for example, I had, agreement with my agent. So who buys through my agent? Right. Now, suddenly I say him that, look, I'll not continue with you. Or tomorrow onwards, your margin will be this. And therefore, I'm giving you compensation for this. All of this is a capital receipt. All of this is a capital which should not be chargeable to tax. Which ideally should not be chargeable to tax. Right? However, this is specifically chargeable to tax. So 28.1 was the general clause. 28.2 is the specific clause which says that the capital receipt which is there will be now specifically chargeable to tax. And specifically, if you look at the clause E with respect to termination or modifications of any business contract. So if you remember, we had discussed one particular case of Saurashtra Cement. Yes, what was that decision? Any compensation paid for the liquidation damages for the delay in supply of the plant and machinery. Supreme Court in that case had held that this is the compensation for the delay in supply of plant and machinery. This is for the purpose of the sterilization of the profit making apparatus. And this is a capital receipt not chargeable to tax. However, with this particular 28.2 clause E, right, in that particular case, now this will be specifically chargeable to tax. Are we clear? So as I told you, capital receipts are not chargeable unless they are specifically charged to tax. Are we clear? Any question, any doubt over here?
Ma'am, suppose a CEO is earning a salary and say he got 1 crore salary for 10 months. Then he got terminated at a compensation of whatever amount, suppose 50 lakh rupees. So that 1 crore will be chargeable under income from salaries and 50 lakh will be chargeable in his hands as a PGBP?
No. So this is a very, very important question. See, if you are into the employment, then you are not carrying out the business or profession. See, for characterizing under this head, profit and gains of the business or profession, the 28 is important. 28.1 says profit and gains of any business or profession. 28.2 has to be read with the main heading that you should be undertaking some business or profession. If you are an employee, then ideally you will not come under this head. So any compensation that you will receive over there will be subject to section 17. Right? It will not be coming under 28.2. Even though you may be managing, but if you are just an employee, the larger picture is that you are not into the business. Are we getting this particular point? So in that particular case, if 17 provides for this similar compensation, then yes, you can be charged under 17. Right? But here, you will not be charged. Now, if you look at 17, 17.3 provides for profit in lieu of salary. Profits in lieu of salary, and it says it includes the compensation received by the assessee from his employer or former employer in connection with the termination of his employment or the modification of the terms and conditions of employment. So, meaning thereby, we are not coming under PGBP, we will still be taxable under the head salary. Are we clear about this? Yes or no? So,
Yes.
in that particular case, you will go under the salary, you will not come under PGBP. So, you have to remain within a particular head depending on what you do. It has to be connected with the business or profession. Are we clear? Okay. So, let's write it down. Section 28 2. Compensation in connection with termination or modification of terms and conditions of contract to number 1, management of Indian company or the foreign company, right? Secondly, agency, or you can also write here the government or the government company. Agency contract, and the last third one is any business contract. Are we clear? So here you will write Supreme Court in Saurashtra Cement had held that compensation for liquidated damages due to delay in supply of plant and machinery is capital receipt not chargeable to tax, as it was compensation for students. What is the word? Yes, it was compensation for
Sterilization of profit-making apparatus.
very good. Sterilization for profit making apparatus. Right? So, however, now section 28 2 E specifically provides taxability of this compensation. This is towards modification in terms and conditions of any business contract. Are we clear about 28.2? Yes, any questions, any doubt? Fine? Okay. Next is 28.3. Income derived by a trade, professional, or similar association from specific services performed for its members. Okay. Now, first of all, students tell me these trade professional associations which are there, right? These trade professional associations work on something called as principle of mutuality. So, these or professional associations are something called as principle of mutuality. Can anybody tell me what is this principle of mutuality? Yes. What is this principle of mutuality?
Members and the members of such organization and the organization inter se are considered as same person.
Yes, very good. So, principle of mutuality, which is there, yes, the club and members are governed by it. Partnership and partners are not, but yes. So, principle of mutuality is that one cannot earn or make profit from one's own self. Right? One cannot make the profit from one's own self. So basically, in the case of these trust, not the trust, the trade associations, like, clubs are there, gym khanas are there, right? Now, these basically operate on this principle of mutuality. Right? So, what it essentially means is one cannot earn profit from one own self. Right? So basically what they are saying is that, we can't really make profit from our own self because here, like in the case of these associations like, gyms, clubs, sports association, cooperative societies to that extent, right? Now, if you are, living in a cooperative society, you will see that they collect lot of charges like maintenance charges, non-occupancy charges, right? Now, these are maintenance charges which are basically collected for you only. These are collected for you only. Like when they collect these entrance fees, maintenance charges, in gyms they collect, membership charges. So they are going to utilize these charges for your own benefit. Yes or no? So whatever you are paying is going to be used for you. So therefore, whatever surplus will also be there that I may use it today or tomorrow. But I will use it for you only. I'm not going to use it for somebody else. So the basic fundamental is one cannot earn profit from one's own self. So this is, in the case of specifically my entrance fees, or membership charges, or for that matter, my maintenance, right? So any surplus which is there will not be taxable. So as per the principle of mutuality, what it says is that any surplus from the general services provided to the members is not chargeable to tax. This is not exempt. Don't use the word exempt. Don't use the word exempt at all. Remember this. You can't be using the word exempt over your students. Because if you use the word exempt, there has to be a specific exemption under the Income Tax Act. We don't have any exemption per se under the Income Tax Act. Are we getting this particular point? This is not chargeable to tax on the basis of the principle of the mutuality. This is not chargeable to tax on this principle of mutuality. It is not exempt. Are we getting this particular point, students? So, whatever transfer fees are there, your non-occupancy charges are there which society collects under the bylaws of the society, that has no element of trading or commerciality. So these are not liable to tax on the account of principle of the mutuality, and there is no taint of commerciality, trade or business. Right? So these are not liable to tax as there is no taint of commerciality, trade or business. This is for the benefit of the members. Are we clear? This is for the benefit of members. So this is what is the principle of mutuality talking about. However, in case, where there is no identification between the contributor and the beneficiary, then the principle of mutuality doesn't apply. Right? So let's say, for example, if the contributor is different and the beneficiaries are different, there is no principle of mutuality which is applicable. I'm not saying that, if let's say, for example, membership charges are paid by all the members, but, benefit is being taken by, few members who want to, let's say, play some sports. Others are not coming only. That is fine. That will not affect the principle of mutuality. Are we clear? So, we are not talking on those points. We are saying that in case of there is no identity between the contributors and the beneficiary. In those cases, the principle of mutuality will not be applicable. So, let's say, for example, there is one case of Supreme Court, which is on the point that whether the interest income derived from the fixed deposits. Let me show you that decision. Now, this is part of your module itself, but this is not in this chapter. This is in the assessment of various entities, but I'm doing it here only because we're talking about mutuality here. Otherwise, I'll not be able to explain 28.3. If I leave this and do it at that point in time in assessment of various entities, there will not be any linkage. So that's the reason why we are doing it at this moment. So that there is consolidated thing with you. When you study the principle of mutuality, you will have everything at one place. You will not read in bits and pieces. Are we clear? So what does this Supreme Court decision is, the issue before the Supreme Court was, does the principle of mutuality apply to the interest income derived from the fixed deposits made with the banks by the club if the banks are the members of the club. So the question was that if the interest income is derived from the fixed deposits which are made by the club has made some fixed deposits with some banks and has earned the interest on that. Now these banks are not some outsider banks, these are the members of the club itself. Whether in that case mutuality principle will apply and interest will not be chargeable to tax? The Supreme Court said that no, there has to be a complete identity between the contributors and the participator. And the action of the contributors and the participators should be for the benefit of all the members. Right? So, and there should not be any taint of commerciality or trade or commerce or earning the profit from that. When do you say there is a commerciality, trade or when there is, the taint of commerciality? When you have a profit motive. So, based on the above principles, the Supreme Court said that in relation to these transactions, the interest which is earned by the club, even though the banks are the members of the club, the principle of mutuality is still the point where the funds are deposited with the bank. Now, once the funds are deposited as fixed deposit with the bank, the mutuality principle ends there. After that, the bank is obviously going to lend this money to the customer. What is the business of bank? Bank will collect the funds as a fixed deposit, give it as loans to the customer. So obviously there is a taint of commerciality with the bank, right? So the interest which the bank pays you as a member is not governed by the principle of mutuality because there is no identity between the contributors and the participators. Are we clear? So if you are depositing the amount towards the bank, and that bank has then the right how it will utilize the funds. The bank is not giving back the money to you. It will give only interest. Then the club loses the control over the money. The bank is then utilizing for its own banking operation. Are we clear? So this disrupts the identicality between the contributors and the participators. Yes or no? So in this case, the principle of mutuality will not be applicable. So the Supreme Court held that the interest income earned on the fixed deposits made with the bank has to be chargeable to tax under section 224. Are we clear? This will not be governed by principle of mutuality. So let us write down this decision. Secunderabad Club, Supreme Court decision. Interest received on fixed deposits from member banks. This is not governed by principle of mutuality as no identity between the contributor, which is the club, and the participator. As bank will lend the money further. There is taint of commerciality, as bank will pay lower interest on FDs and lend money at higher interest. Are we clear? So this is not governed by the principle of mutuality. The other decision is again Supreme Court in the case of Venkatesh Premises Cooperative Society Limited. Whether the non-occupancy charges, transfer charges, common amenity charges received by the cooperative society from the members are exempt on the basis of mutuality, the Supreme Court said yes. The person which is collecting the society are using these charges for the benefit of the members itself. Right? So in this particular case, the principle of mutuality will be applicable and therefore here it will not be chargeable to tax. Are we clear? This is what we have already understood. Next decision is in the case of Madras Gymkhana Club, Madras High Court. Would the interest earned on the surplus fund of a club deposited with the institutional members satisfy the principle of mutuality? Same thing. Here, they are not depositing it with the bank, but they are depositing it with some company, some institutional member. So, these again are not satisfying the principle of mutuality because there is no identity between the contributor and the participator. So, the Supreme Court decision, which we have just looked at it, which is Secunderabad Club, same will be applicable over here. Next is Bombay High Court ruling in the Sindh Cooperative, which is again asking can transfer fees received by the cooperative society from its members who are incoming and outgoing is exempt on the mutuality principle? The answer is yes, because here this is for the maintenance of the property. There is no taint of commerciality, trade or business, and therefore this will be not chargeable to tax. Are we clear? Any questions, any doubt? Yes or no? Are we clear about this? Yes? Okay. Everybody? Okay. Now, this is about the surplus. So, surplus from the general services provided to the member is not chargeable to tax on the basis of the concept of mutuality. Right? This is not chargeable to tax as there is no taint of commerciality, trade or business. And there is identity between contributors and the participators. Now, if you look at this is surplus which is exempt, or sorry, not exempt, it's not chargeable to tax. Now, if there is some deficiency which is there, so surplus, this is not chargeable. Right? On the basis of mutuality. However, if there is some deficiency, what is deficiency? My expenses are greater than the income. Quite possible societies, these clubs incur a lot of expenses. They may not receive the income or the receipts in respect of that. There is certain deficiency which is there. In that particular case, there is section 44A which is applicable. What is 44A? Special provision for deduction in the case of trade, profession or similar association. What does 44A provide? notwithstanding anything to the contrary contained in this act. Overrides, this is a non-obstant clause, where the amount received during the year by any trade, professional or similar association from its members, whether by way of subscription or otherwise, not for remuneration received for rendering any specific services to members, fall short of the expenditure incurred by such association during that previous year. Right? Not being a capital expenditure or not being expenditure deductible in computing the income in any other provision. So any expenditure which is not deductible and it is not a capital expenditure. So where my expenses which are other than deductible or any capex, right, is greater than my receipts, and these are incurred solely for the purposes of protection or advancement of the common interest of the members. Basically, when you are governed by the principle of mutuality, the amount so fallen short, the deficiency, hereinafter referred to as deficiency, shall, subject to the provisions of this section, be allowed as a deduction in computing the income of the association accessible for the relevant assessment year under the head PGBP. And if there is no income accessible under that head or the deficiency allowable exceeds such income, the whole or balance of the deficiency, as the case may be, shall be allowed as a deduction in computing the income of the association accessible for the relevant assessment year under any other head. So what it is saying is that even though we are not taxing the surplus, the deficiency which arises on account of mutuality, this we will allow as a deduction against any other PGBP, or if there is no PGBP, any other head of income. Now, what is allowed in computing the income of the association for the relevant assessment year under subsection 1? Effect shall be given to any other provision of the Act under which any allowance or loss in respect of any earlier assessment year is carried forward and set off against the income for the relevant assessment year. The amount of deficiency to be allowed as a deduction under this section shall in no case exceed 1/2 of the total income of the association. Are we getting it? So, what is the amount of deficiency which is allowed is half of my total income. So, this will be restricted to half of my total income. Are we getting it? So, surplus is not chargeable to tax on the basis of mutuality, and deficiency we will allow it. This is only in the case of the general services to the member. And this is, remember, only applicable to trade or professional association. This is not applicable to cooperative society. Cooperative society is not a trade or professional association. This is not applicable to cooperative society. Are we clear? So, this surplus which is there is not chargeable, but even then we will allow the deficiency restricted to 1/2 of the total income. And this will be allowed against any other PGBP or any other head of income. Are we clear, students, up till now? Yes or no? Yes? Any questions? Any doubt?
मैम मतलब जितना भी डेफिशिएंसी है उसका हाफ ही अपन अलाउ कर रही है ऑफ द टोटल
Yes.
इनकम तक का.
Yes.
ओके
Fine. Okay. Now next one is 28.3. So see, many of you may be feeling like, ma'am is taking from here and there and then. So, but you will appreciate this when you will start revising everything. So you may be feeling like, I came to 28.3, all of a sudden I'm discussing about the principle of mutuality. Then again, I'm, discussing about, you know, 44A. I discussed about the case laws on this subject. All this is because I want you to consolidate everything at one place. I can go, 28.1 says this, 28.2, but you will not be able to apply it in exam anything. And neither in your future. Right? That's the reason why we are going from here and there. Okay. Now 28.3, what we started with, is saying what? Income derived by a trade, professional or similar association from specific services performed for its members. Now can anybody tell me what is 28.3? We studied that, income from the professional, similar association, trade association is not chargeable to tax on the basis of mutuality. Then what is this? What is then 28.3? What it is trying to charge to tax? Can anybody tell me? This is from the specific services. See, I'm emphasizing again and again, this is on the general services. With respect to general services to members, you have the concept of mutuality. With respect to the specific services, concept of mutuality doesn't apply. What do we mean by the specific services? My specific services here mean, let's say, for example, renting of hall to member for some party. So the income that I charge, the rent that I collect, right, from the member is chargeable under 28C because it's a specific service to one member. The clubhouses are let out to do some function, to do some housewarming. Those are the specific services. Right? So that will be chargeable under 28C. Now this is specific services by trade or professional association. Again, this is not applicable to cooperative society. Are we clear? So renting of hall to members or doing some sort of, function, allowing some parking and collecting, parking charges for a particular member. All of these are income from specific services that will be chargeable under 28th. Now, will 44A be applicable over here? The answer is no. 44A is not applicable for 28.3. Can anybody tell me the reason?
44A is for general services and it is for
Yes.
specific service.
And also because the 28.3. So you will get all the deduction of the permissible expenses. Right? Because this is the income chargeable under 28.3. So you will get depreciation, you will claim, like whatever expenditure, salary and all of that is there. So that you can any which ways claim. So why do you need 44A? Are we getting it? So now are you able to appreciate? See, if I would have told you income from specific services by trade professional association, would you be able to understand anything? Answer is no. That is the reason why I first told you what is mutuality. And since we discussed about mutuality, we also covered the cases, because there in isolation, again, you will forget what is the mutuality. Are we good to go about 28.3 students? Should we proceed ahead?
Yes, ma'am.
Yes? Okay. Now 28.3a, profit on sale of a license granted under the Import Control Order, made under the Import and Export Control Act. Self-explanatory. Again, if you see, this is a capital receipt, profit on sale of a license. This is a capital receipt, right? License is a long-term license. If I sell that license, this is a capital receipt, but this is specifically charged to tax. Cash assistance received or receivable by any person against the exports under any scheme of the Government of India. Again, cash assistance is a capital receipt, but this is specifically charged to tax under 28.3b. Any duty of customs or excise repaid or repayable as a drawback, duty drawback under the excise or customs law. Again, this is a capital receipt, but specifically charged to tax. Any profit on the transfer of the duty entitlement passbook scheme. So any transfer of the duty entitlement passbook scheme is again capital receipt, specifically charged to tax. Any profit on the transfer of the duty free replenishment certificate, again this is capital receipt, specifically charged to tax. So this I am not writing in detail, this is a self-explanatory thing. 28.4, very important. The value of any benefit or perquisite arising from the business or the exercise of a profession, whether convertible into money or not, or in cash or in kind, or partly in cash and partly in kind. So let us write down 28.4. Any benefit or the perquisite arising from business or profession, whether in cash or in kind, right? Whether in cash or in kind, whether convertible in money or not. Okay, so this is a specific provision which is trying to target the value of the benefit which is there, which you receive while exercising your profession or while exercising your business. If you receive any benefits or perquisite, for example, if somebody gives, like manufacturer gives a car to the dealer, right, this is a kind of a benefit or a perquisite. So that is what is subject to be covered over here. Now, some years back, if you had looked into this provision, there were many Supreme Court judgments which had held that the cash benefits are not supposed to be covered over here. However, the law has been amended and now they say that whether in cash or in kind. So meaning here cash benefits are also supposed to be covered over here. Are you getting it? Sorry, I think there was some issue. Yeah. So the cash benefits are not supposed to be covered over here. Oh, sorry, the cash benefits were earlier not supposed to be covered over here, but now they are specifically covered under 28.4. So it says value of any benefit or the perquisite. Right? Now, what are the kind of value of any benefit or perquisite that we are trying to cover over here? We'll spend some time on this particular point also. So, let's say for example, any kind of waiver of loans, whether that is a benefit or perquisite.
Yes, ma'am, because he don't have to pay the loan, right?
Yes. So the loans waived by the bank or financial institution either charge 8.4 or should be chargeable under 41.1. Now, what is 41.1, students? Twenty-eight four. Okay. So what I was talking to you about, like waiver of loan. Now, waiver of loan can be covered under 28.4. You can say this is a benefit. It can also be covered under something called as section 41. What is 41? Profits chargeable to tax. Right? So it says where any deduction has been claimed and there is any expenditure or any trading liability incurred by the assessee, and in subsequent year there is a waiver of that liability. Right? So there is a waiver, remission or cessation of that liability. So the question is that whether we should apply 41.1 or 28.4. Now 41.1 which is there. If you look at the language here in 41.1, it says students 41.1 is with respect to where an allowance or a deduction has been made for any year in respect of loss, expenditure or trading liability incurred by the assessee. And subsequently during any previous year, the first mentioned person who has claimed the deduction of that expenditure has obtained in cash or in kind any amount in respect of that loss, expenditure, the remission or cessation of that liability. So the person who has claimed the deduction has now got the waiver benefit he has got by way of remission or cessation of the liability. Then the benefit which is obtained by him will be deemed to be the profit and gains of business or profession. So the condition for 41(1) is that I should have claimed a loss or the expenditure, and now that is getting waived off. Now that trading liability is getting waived off. In those cases, 41(1) applies. But in the case of the waiver of the loan, it is not 100% of the times that I will have claimed the deduction for that loan. So the waiver of loan is in therefore that case may be covered under 28(4) and not under 41(1). Are we clear, students? Yes or no?
Yes, ma'am.
Now,
Ma'am,
yes,
can you explain once again, ma'am?
yeah,
41.
yes. So 41(1) says that for the applicability of 41(1), I should have claimed the deduction of the expenditure which is now getting waived. The liability in relation to that expenditure is getting waived. Let's say I've done purchases, I've claimed deduction of purchases. Now I don't have to pay to my creditors. The creditors are waiving my liability. So this is the benefit which will be covered under 41(1). So for 41(1), I should have first claimed the deduction of the expenditure for 41(1) to apply. For 28(4), there is nothing like that. So the waiver of loan, when you waive off a loan, I have not claimed any deduction. Now you will say, ma'am, we have claimed the deduction for interest. Interest is a separate item. Purchase and creditors are connected. That is what is covered under 41(1). Loan is one thing, interest on loan is another liability. You have to pay principal plus interest. So 28(4) will apply on the waiver of loan and not 41(1) because you have not claimed the deduction of the loan. Are we clear now?
Yes, ma'am.
Yes. Okay. So now in this particular case, they have tried to cover under 28(4) any kind of business gifts also. Any kind of subsidies also. Subsidies are again what? These are benefit. Right? When you get the subsidies are usually the capital receipt. Right? The subsidies, if they are given to you to promote the industrial development or any longer term objective, are ideally the capital receipt. The subsidies which are given for your day-to-day business, that is the revenue receipt. That is any which way is taxable. But the capital receipts which are there, the subsidies which are given for the infrastructural development, that is a capital receipt. Now that will also be chargeable to tax over here. Are we getting this particular point? So what is intended over here is waiver of loans, subsidies, business gifts. All of this is to be covered. And now we have a specific TDS section in relation to this. See, now again, if you will do 194 hours separately, you will not understand, students. It has to be read in consonants. Otherwise,
Ma'am,
see, if you
one
would,
question.
yeah,
Just these subsidies. So a company receiving capital subsidy for the purchase of plant and machinery, normally it gets in different areas. Also in case of there are many subsidies जो मिलता है उसमें what we do then we will charge the tax to this.
yes, we will charge. We will cover the
Or
subsidies over here. Okay, unless and until there are subsidies which are going to reduce the cost of asset, you will cover the subsidies under 28.
suppose a subsidy given to purchase plant and machinery, then
then you will reduce it from the cost.
So
So
it will
that
not
we
be
will learn
charged.
in the, yeah. See, we are going to talk about that also. So okay, if you have raised the issue, let's discuss this. If you look at the definition of the income, if you look at the definition of the income, it says assistance in the form of a subsidy, grant, cash incentive, duty drawback, waiver, concession, reimbursement by the central or the state government or any authority or body or agency in cash or in kind to the assessee is a income, right? Other than the subsidy or reimbursement or grant which is taken into account for determination of the actual cost of the asset. So when it comes to the subsidy, so if it is a revenue subsidy, this is any which way is my income, right? This is under 224, right? When it is a capital subsidy, if it is relating to the capital asset, then you will apply reduce the cost of asset as per explanation 10 to section 43(1) and students ICDS and students ICDS 7. Are we getting this particular point? And if it is a capital subsidy not relating to the capital asset, this will be chargeable under 28(4). Are we getting this particular point? Is this clear now to everyone? Yes?
Yes, ma'am.
Okay. Now coming to the TDS on this particular amount and the circular in relation to that TDS. This is very important. 194R provides now any person responsible for providing to a resident, not covering non-resident, the recipient is resident, any benefit or perquisite, whether convertible into money or not, arising from the business or the exercise of profession by such resident, shall before providing such benefit or perquisite ensure that the tax has been deducted at the rate of 10% of the value of the benefit or perquisite. So now on this particular amount, there is a TDS under section 194R, which is at the rate of 10%. And what is the threshold? The threshold which is given is respect of 20,000 rupees. So if the amount exceeds 20,000 rupees, then only if the value of benefit is greater than rupees 20,000. Are we clear? And this provision shall not apply to individual or HUF whose total sales are less than 1 CR or in case of profession 50 lakh in the preceding financial year. Are we clear? Yes or no, students? Yes? I'm not getting answers. Is it
If
clear?
whose
Yeah.
sales gross sales means the person who is paying. We are referring to that, the payer.
Yes. Yes, the payer. Okay. Now, coming to this particular circular. See, this is a CBDT circular for the guidelines. As I told you, circulars are issued to clarify something, right? So this is binding on assessee?
No, ma'am.
No, circulars are not binding on assessee, are binding only on the revenue. Now what does this say? It gives certain guidelines. Is it necessary that the person providing the benefit or perquisite needs to check the taxability under 28(4)? So if I am providing you the benefit for the purpose of TDS, do I need to check? The answer is no. It says that it is not required that one needs to check that for you it is chargeable or not. I need to just deduct the TDS. Very simple. Secondly, in case the benefit or perquisite is given in the form of a capital asset, then how do I deduct the TDS? Right. So let's say, for example, they have given this particular examples over here. Assessee has entered into an agreement for the purchase of plot, and the amount was paid as some earnest money, booking money. However, possession of land was not given to the assessee, and the seller entered into another agreement with a third party to develop the said plot. Now, assessee filed a suit and he won the case, and some amount therefore was paid to the assessee. So the court said this is nothing but a benefit that the assessee has got. This should be chargeable under 28(4). Or let's say, for example, some principal loan is waived by the bank under the one-time settlement scheme. This is chargeable under 28(4). Value of rent-free accommodation, furnitures, fixtures given to the director who is not an employee. The director is not an employee. If he is employed, then we have the value of the rent-free accommodation under section 17, treated as perquisite. This is director who is the non-employee director, not a full-time director. Is also a benefit under 28(4). When a car is given to an assessee, again it is 28(4). Shares were allotted to the director who is not an employee. It is a benefit under 28(4). Gift of land on the carrying of vocation, 28(4). Now in this case, when the capital asset is given, how do I deduct the TDS? So the TDS has to be deducted and paid to the government before releasing the asset to the payer. To the payee. Are we clear? Next is whether sales discount or the cash discount or the rebates, whether these are the benefit or perquisite. So when you purchase a product, you get a cash discount on Amazon, right? So the purchase price itself will get reduced.
Ma'am, one question. Then in such case, where that capital asset is provided, so with like the payer or person whosoever is giving that will collect TDS from the receiver?
No, he will not collect. Basically, what he will do is he will deposit the TDS. Of course, he can collect it because it is his principal liability to collect it or deduct the TDS before the release of the asset. So the amount of the benefit, let's say if the car is worth 10 lakh and the TDS comes to 10%. So the 1 lakh amount has to be deducted. Of course, then he can, collect it from the particular pay, or he can, take the obligation on his own self.
Now, if he collects, then will it be grossed up system will be applied here? The way we apply that tax when the tax is paid by the employer case.
Yes, but in this particular case, how will you gross up? Because the thing is that, of course, you need to gross up the value, but whatever you collect will be part of the contractual arrangement. Like, let's say we will do 10 lakh into 10 divided by 110. So that's how, I will collect the, deduct the tax in that case.
Okay.
Fine. So we will gross up essentially. Obviously, if I am bearing the TDS liability, I will gross it up. But that is all dependent on, it's not, something provided by the law. It is something that depends on the contract between the two people. Are we clear? Any other question?
Ma'am, if TDS is not collected by him, it is also kind of giving a benefit to the person, right, ma'am?
Yes, it is a kind of benefit, and for that we have a specific section, right? Which says that again, if we like, if it was in the nature of employment, there is a specific section wherein the tax obligation paid by the employer on behalf of the employee, then it is considered as benefit in the hands of employee. But there is no similar section under PGPP. There is a section under the salary, but for PGBP, there is no similar section. So yes, one can say that again, this is a benefit under 28(4) itself, because it is the liability of the purchaser and not the seller. And then accordingly, they can charge under 28(4). That's a very good question. Are we clear?
Yes, ma'am.
Okay. Now, in case of these cash discount, sale discount, yes, the CVDT says these are benefit, no doubt about it. But if we, subject the cash discounts and the sales discount to even tax, like TDS, it will prove a lot of difficulty. Cash discount is what? Like if you pay in cash, you don't take the credit period, we will give you discount. Like let's say if you, pay entire amount today, we'll give you some discount. Now, if I subject this to TDS, this is going to pose a lot of difficulty. Are we clear? So therefore, in that case, the CBDT has said we are removing the TDS in these situations. So on cash discounts and trade discounts, the TDS will not be applicable. So just write it over here. Although this is a perquisite. So cash or trade discount, these are perquisites, but no TDS under 194R. Are we clear? But they say this relaxation should not be extended to other benefits provided by the seller in connection with sale. For example, when a person gives incentives in the form of some car, TV, computers, gold coins, mobile phone, that is not, or that on that TDS will still apply. When a person sponsors a trip for the recipient, or his relatives upon achieving certain targets, like the manufacturer gives the targets to the dealers that if you sell this much, we will sponsor a trip for your family. That is an incentive. When a person provides free ticket for event, let's say you give Arijit Singh's concert ticket, that is a benefit. When a person gives medicine samples free to the medical practitioners, in that case also this is considered as the perquisite. And on all these cases, the 28(4) will be applicable. Are we clear? So when free medicine samples are provided by the pharmaceutical company to the doctors, the TDS under 194R has to be deducted by the pharmaceutical company, even though the benefit is provided to the doctor, but the TDS will be deducted in the hands of the hospital if the doctor is the employee of the hospital. Because in substance, he is working for that hospital, so the benefit is provided to the hospital itself. Then the hospital may subsequently treat this benefit under the hands of the employee under section 17 and deduct the TDS under 192. So what will happen is, let's say for example, free medical sample to doctors. You can write in the hands of pharma company, in the hands of hospital and the doctor. Are we clear? First, we are talking about in the hands of hospital. Now, this is applicable if the doctor is employee of the hospital. Then the pharma company has to deduct the TDS in the hands of hospital under 194R. Right? Now what will happen here is, in the hands of hospital, first income in books of hospital. Secondly, deduction of the expenditure paid in form of benefit to doctor. Now in the hands of the doctor, if the doctor is an employee, in that particular case, number one, salary for perquisite received and TDS under section 192. However, if the doctor is independent, then directly here the TDS under 194 will apply. Are we getting this? So here the hospital will deduct the TDS under 192. In the hands of the pharma company, no deduction of the expenditure. This is under section 37, expressly disallowed. So any free samples to the doctors is not considered as the expenditure, deductible expenditure in the hands of the pharma company. There's an express prohibition. Are we clear? However, it needs to deduct the TDS under section 194R. Is this clear, students? Yes or no?
Yes, ma'am.
Okay, perfect. So this is how you have to again link and do it. Clear? Now, how will you value the benefit or perquisite in the form of a capital asset? So they say that the purchase price shall be the value, right? Or if the benefit or perquisite provider manufactures the charges to the customer, that is what is the value. Now, next is, many a times the social media influencer is given a product of a company so that he can use the product and make a video for that. Is the product given to such an influencer a benefit or a perquisite? Now, in case of benefit or a perquisite which is given in the form of, like, some makeup items, some clothes which are there, and if the product is returned to the company, it is not a benefit or perquisite because I don't get to use it. I'm just making a video for you. However, if the product is retained with them, then yes, this is a benefit or perquisite. So, product given to social media influencer, if returned, this is not a perquisite. If retained, then yes, there will be TDS under section 194R. Now, these can come as a part of case studies for your examination students, right? Next is whether the reimbursement of out of pocket expense incurred by the service provider in the course of rendering the service is benefit or perquisite. What is out of pocket expense? Yes, what is out of pocket expense?
सर्विस प्रोवाइडर के खुद के जेब से पैसे लगना.
Correct. So let's say, for example, that if a consultant is like we as CAs are also rendering the service, like we go to audit place, right? So one we receive is the consultancy fee or the audit fees. Second is that I have to travel to the audit place. So therefore I charge for the out of pocket expense. If I am going outstation, I have to do the charge for the boarding and lodging expense. Now the expenditure which is incurred by me, if I am incurring, I will of course claim it as an expense. In case I charge it to my client, then it is the benefit which is provided to me because I get to stay in hotel, I get to eat the food. So now you have to be careful when you go as for articleship. You may think, oh, ये तो free का खाना है, ये तो free का hotel है, right? Many times it happens if you go for listed companies audit, you get to enjoy all the perks, but that is indeed a taxable perk for you, right? Now, what happens sometimes, like when you go on and stay in that hotel. Now, the invoice of the hotel is not in your name. It is generated in the name of that company because that company wants to claim the deduction of that expense, right? It is incurring that expense for you. You may pay that expense at that point in time and they will reimburse you. So, in such a case, the expense which is paid to you and will later on reimbursed by the client, and the invoice is in the name of the client, right? So the reimbursement which will be done is not a benefit or perquisite because the invoice is in the name of client. However, if the invoice is not in the name of the client, the invoice is in your name, and then they reimburse it or pay it directly to them, then it is a benefit or the perquisite. So out of pocket expenses. If invoice is in name of client and payment by consultant later reimbursed by client, this is not a perquisite. However, if invoice is in name of consultant and reimbursement by the client, then this is perquisite under 28.4. Are we clear about this, students? Yes or no? Okay. Last one. If there is a dealer conference to educate the dealer about the products of the company, manufacturers keep these conferences about explaining the products and all of that, about launch of new product, all of that. Now, whether this is treated as perquisite. So this is not perquisite if it is just to educate the dealer about the product or address their queries. However, let's say, for example, if certain incentives are given to the dealers, right, who have achieved a particular target, or when they come to that resort, there is also some leisure component in the trip, which is incidental even to the dealer conference. Like you come, conference is till 4 p.m. After that, we'll go for sightseeing. You can accompany your family members also. You can extend your stay also or come early also. In those cases, this is a perquisite. Are we clear? So just write down. Dealer conference. If for explaining the product, this is not perk. However, if it is for to provide incentives to select dealers for achieving target or for leisure trip, even if incidental, then this is the perquisite under 28. Are we clear, students, about this?
Yes, ma'am.
Yes. Geet, you have a question. If in year of deduction is made on respect of expenditure on accrual basis and in subsequent year the liability has been waived off, the benefit received will be charged in the year in which the benefit is received. Yes, that's correct. Okay. So we'll stop here, students, and I will request you to revise everything till now what we have done so that it gets registered with you, right? Because we are going to discuss a lot over here. I hope you are liking the pattern that we are interlinking everything at one place, because this will help you on your exam day to revise everything properly and will help you to write your exam better also. If you have any feedbacks, you can always, reach out to us, give your feedbacks, give your suggestions that are always welcome. So with this, I'll stop here. I think we can end the session. Yes.
So you can scan from your mobile phone, okay, and you can join this session. Today there will be 3 MCQ only based on your previous class. Class, can we start? Okay, so now move it with the next question. Actually, the answer was 15 lakh. You can see the answer on your screen when you will give the answer. Okay, whether it is right or wrong, you will get the answer. Now move to the next question. Which of the following is not taxable? So everyone gave the answer. Okay, Yogesh was right. So now move to the next question. Now we can end the assessment. The first one is Chitra, second one is Yogesh, and third one is Keith. Okay, we're having one chat as well. I can give you the answers. So, any doubt? If you are having any doubt, you can just message in the chat. Thank you so much. Okay, thank you so much, Geet, for attending the MCQs. Now we can close the session. Yes, sir. You can close the session. Thank you, sir.